gravitating towards kind of rules-based discipline strategies, and trend following as a philosophy was something that kind of came on my radar screen maybe in the late 90s.
All right, everyone. We are going live with episode 8. Is that right, Josh? Or we're on 9 already. Wow, time flies.
We made it past the 7.
This is a good problem to have. We're already in that kind of phase where it's like, what episode is this? We've done so many of them, but episode 9 of Building Better Portfolios. Yeah, exactly. But no, super excited for today's conversation with Cole Wilcox. He is the Chief Investment Officer at Longboard Asset Management. And the reason this topic is exciting to me is that Cole and his team have a trend following strategy, and a trend following strategy which is very unique and differentiated from some of the more kind of familiar, fully long, short, unconstrained trends. So I had the opportunity to sit down with Cole a couple weeks ago and learn more about kind of the firm and their philosophy behind this. And it's super exciting. And so I'm excited for Cole to share their story. But before we dig in, Josh and I are really just focused on education. And I think that this is an area of the market that a lot of people have been looking for new solutions, more innovative solutions as the market broadly becomes more and more concentrated. And so I think Cole's approach to this space is one that I think a lot of us can benefit from learning more about. So Cole, maybe let's just kick off then, just by way of background, if you want to share kind of your kind of experience in the industry and kind of Longboard's approach and philosophy in the market, that'd be helpful.
Yeah. Thanks for having me on the show today. The background, I think I started my career in about 1996-ish kind of thing. And so the way I got into founding Longboard was kind of a byproduct of that first 5-year cycle of investing when I was young and new to my career. And there was a boom and then a bust and then a boom and a bust. And I saw a bunch of people make a bunch of money and lose a bunch of money and kind of go through this crazy cycle. And it's there's got to be a better way than just this up and down. And I ended up gravitating towards kind of rules-based discipline strategies, and trend following as a philosophy was something that kind of came on my radar screen maybe in the late 90s, early 2000s. And it just seemed to be a philosophy and approach that had been the most robust at navigating lots of different market regimes, kind of historically. And that was very appealing, to me, because I had not seen people successfully navigate boom bust cycles very effectively. And I saw them, make a bunch of money, lose a bunch of money, and everything in between. And I was like, this is, not great. So that's how we got started, and kind of led to a research process. And 25 years later, still doing the same thing. So I'm a trend guy, and learned that kind of the trend is your friend. And that's kind of.
Yeah, I love too. Just the longevity of this approach and philosophy. I think a lot of times we'll see new approaches come to market and they're, back tested or fitted for the most recent past. And so the fact that you guys have been following this approach for decades through different market cycles, different interest rate environments, different, equity concentration type environments, really kind of speaks to how rooted this is and kind of being successful in the industry. So I love that. Before we jump into the strategy, a question that we often like to ask our guests is, what is something that most people may not know about you? And I think it's also helpful just so people kind of get an idea of who you are as a person, whether it's interesting hobbies or background. So would love to hear what.
Not know about me. I don't, it's a good question. Maybe they don't know that I have 4 kids in my life. That's kind of probably the biggest thing. So I'm pretty busy with my own son and my fiance's son and her 2 sons and daughter. And that keeps me pretty busy at life. I think that they're not aware about the scope of the family that's behind me. Is maybe something that is new and interesting because I don't talk about it.
Yeah, well, kudos to you. Kudos to Josh as well, who is moonlighting as a parent outside of our day jobs here. I always say there's not enough time in the day and I don't have any dependents. So that's awesome. And fiance, congrats. Yeah.
Thank you.
Cole, I'm going to follow up with one more question. Is that okay?
Yeah.
I'm a big reader, and I can tell by the books behind you that you're probably a reader too.
Oh, yeah.
Is there any book that's had a big impact on you in the last year, two, whatever, just a book. And I'd love to just hear.
Yeah, I always give the same recommendation to everybody because it was kind of like a life-changing book for me. It's not new. So I was hugely influenced by Charlie Munger in my life, the former vice chairman of Berkshire Hathaway and Warren Buffett's longtime business partner. And there is a book called Poor Charlie's Almanac. And it is a book that I say is like just an essential read for anybody. And it's just a book on interdisciplinary education and the importance of having different mental models from all kinds of different disciplines and how that improves your decision making and approach, whether it's investing or other kinds of things in life. And philosophy, other kinds of stuff about it is just chock full of just fantastic, incredibly profound ideas. And I'm 48 today. I probably read that book when I was 30. And it was very much like there was a pre that book and a post that book. And I recommend it, to everyone.
Love that.
But it's like not a book you read. It's like you have to sit and there's this one chapter and then you're like, well, I need to think about this for like a month. And then do the next one and kind of like get through it. So yeah, that's the number one book that I would say was life-changing for me.
Cool. I've heard of it. Okay, great. Let's get into the topic at hand then. I thought what would be helpful, Cole, rather than kick off by talking about markets and such, I think given the uniqueness of your approach to trend following, it might be beneficial for our audience to hear kind of the basics. How do you guys think about trend following? I know you guys are taking more of a long only type approach. So maybe just some high level statistics on how you guys approach trend following within equities and what makes your strategy unique.
Sure. I mean, to understand the uniqueness of it, then maybe we need to talk about kind of everybody else, right? And then to understand why it is unique. So we didn't start this way. I didn't come to the table with the strategy that we have today. I actually kind of came to it with understanding trend following through the traditional portfolio and the way the industry kind of thinks about it, whether you call it CTAs or managed futures. You have a strategy, it's long and short, it's following trends either up or down, and you're doing it across a multi-asset portfolio, right? So it's currencies, commodities, fixed income, and stock market indexes. So kind of a macro global portfolio doing long short trends. And that approach has a long track record. There's managers in the hedge fund world that go back decades doing it. And pretty much has been bought because it's been a source of non-correlation and throughout market cycles and a great source of diversification with returns that, weren't terrible. So that's how I came about it, was like discovering that kind of as an industry and then investing in those strategies. My first approach was not to have our own proprietary strategies. I actually came at it as an allocator and investor first, did due diligence on every manager in the world and that were in the space and made allocations to them and built portfolios. So I experienced systematic trend following through the life of an investor first. And I kind of realized that you can look at a track record and go back multiple decades, but then you have to kind of suffer the real world experience of that. And one thing about trend is that because it is so different, it's going to move very different and very non-intuitively from other assets kind of in the world, which when you have an environment where you don't get an outcome that everybody else is getting, and that outcome is negative, you're underperforming, you're losing money, that creates like a real kind of cognitive dissonance for an investor. Like it's really emotionally difficult to be like, wow, I'm losing money and I'm losing it in a different way than everybody else is. Because now you're just isolated on an island and it's like, am I right or am I wrong? And it starts to mess with your head. That is what systematic trend multi-asset strategies, like it's not a flaw. It's a feature.
I would concur. And maybe just a quick comment too, for those listening, that's the world that I live in, and my day job is more of that tail risk hedge, crisis alpha, that extreme or maximum diversification approach for trend following. And to your point, those returns have been and generally are quite episodic. So I think that's probably where you're going, is like, how do you solve for that? Although it is the feature, can be viewed as a bug from a client experience perspective.
Yes. So the feature, which is something that also gives you low correlation and maybe sometimes positive returns when the market, like the crisis alpha that you're talking about, if there's a '08 or a 2022, you might get a positive rate of return in that one period. And the downside of it, though, is you might underperform for 9 of the other periods, prior to that, if underperformance is like you versus the S&P 500 as an example. So, underperforming a standard asset like the S&P for 9 years to get 1 year of, great performance relative to it is generally pretty tough for people, especially when the math of like diversification and non-correlation is kind of like non-intuitive. We tend to look at these component parts of like A versus B, and that's an issue. So I have both been an allocator to the multi-asset, but our first mutual fund that we launched was also a multi-asset systematic, trend fund, and we grew it. I've raised over $1 billion in assets for that fund, and kind of have experienced it being a fund manager who also heard from financial advisors and from our clients and shareholders about their own emotional experience and kind of when they were buying, when they were selling, what it was going through. And it's like, we would look at it and be like, look, mathematically, we're doing our job. We're low correlated. We're delivering crisis alpha. Those are all true things. And so, but what the byproduct of doing what we do is that it can be a very emotionally challenging asset class or strategy to hold for most people. And that's kind of just, what it is. Most people are not portfolio managers. They don't kind of put things together, and they're going to make decisions in a very different way. And so we realized like that first product was actually like a failure, honestly. Like it was a commercial success. We raised assets for it, and we, collected fees and things like that. It was, I guess, good for us. But ultimately in the long run, it was a commercial failure because you had investors ultimately got frustrated. They redeemed, they left. It wasn't, definition of success isn't, did you outperform your benchmark? Okay, yes, you outperformed your benchmark, but your clients fired you. It was clearly not a successful experience from what should matter, which is your shareholders. So the questioning of that, though, is like, well, was this is this a trend following problem? Like, is it like, hey, just throw out trend following and trend following is broken and they can never make anybody happy? Or is it an application of trend? Is it how are you putting something together to create something where you can reformulate it in a way that will give people what they want, but also extract the things that they don't want, or find some middle ground between the two? So what we kind of focused our time and attention on was everybody is using systematic trend to diversify equity risk, right? Equities are too risky, they're too volatile. We want low correlation to diversify it. The question is, could you reduce the equity risk and apply trend following was more direct, right? Instead of having to do it with long short commodity futures or things, could you do it by applying trend following to individual securities? And that was kind of a question in our research that we went about doing, and like 20 years ago, and found out that you can get the outcome that you want, which is downside risk management and diversification, low correlation, those kinds of things, by applying systematic trend following to individual securities and running. You called it long only before, but I would just call it like, it's not really long only, because we could be 100% treasury bills, right? So there's a risk on, risk off kind of, pathway to it. And when you own low correlation treasury bills in a market crisis, you're going to provide low correlation during a,
Yeah, great point. So just to clarify, the ability to go to cash, which would be that risk off view, but you aren't outright shorting individual stocks. Okay. Correct.
Shorting individual stock trends is not a thing that we do, or that we're trying to seek alpha, for a whole host of reasons. But yeah, we're not doing that part of it in the part. We're either capturing the best performing security trends in the market, or if there are zero, positive trends that are happening across all individual securities, because we're in a market crisis, we're going to rotate to treasury bills and just be very low vol, low correlation with that asset in our portfolio.
And so from a construction perspective, your approach is entirely rules-based or systematic rather than being discretionary, correct?
Yeah, it's 100% systematic, 100% trend following, 100% data price trend, driven. We're not using fundamental inputs into the buy sell decision criteria. We acknowledge that fundamentals obviously matter to what the outcomes are and what happens with businesses and things like that. But as far as the inputs into our models, it's pure trend following is the underlying mechanics.
And what's the universe that you're looking at?
Our universe is every single security that is a member of the Russell 3000. So the 3,000 largest U.S. publicly traded companies.
And you made a reference, Cole, that although, from a stock perspective, fundamentals can matter. We were kind of joking before we went live for today's episode is like, do fundamentals matter anymore? Which might actually be a good segue to the topic around thinking about the application that your strategy employs within trend following, which is a more technical indicator, of course, for investing. Why do you think today's environment this environment is conducive for a strategy like longboards as it relates to trend following for individual equities?
Well, I don't know that today's environment is any different in terms of conducive for individual equities versus previous. I don't think that today's environment it's not different from a trend following standpoint. Like our research would show that the markets are a power law. So 5% of the stocks in the market are going to have these massive trends, and they're going to generate 100% of the market's overall return. And the rest of the securities are going to wash out to basically be nothing, with a very healthy segment, like a more than a quarter, that'll end up going bankrupt and like losing all of the money, right? So there's this very healthy segment that's just like take a dirt nap, a bunch of mediocrity stuff in the middle that nets out to nothing, and then a small tail that's just these monster mega winners. Nvidia today would be an example of something like that. What's unique about today's market right now, I think, relative to historical context, is we are at the upper thresholds from a valuation standpoint in certain segments of, I'm not saying broadly every stock, but there are certain securities that are kind of reminiscent of a 1999, 2000 kind of environment where they're trading at very large price to sales multiples that kind of don't make sense, or businesses that have no revenue that are trading at market caps that are kind of debatable about whether or not that is in the realm of reality or not. You also have the S&P 500 in a very concentrated kind of world right now. There's a handful of stocks that are not just driving the performance, but also or dominate the market cap, kind of thing. So that level of concentration and the level of valuation, is at a point where we haven't really seen that for 25 years in the market, kind of thing. So that to me is kind of what is. You also have a very lopsidedness in the economic kind of world, like that K-shaped thing that's happening in the economy, where the power law of the economy, or the power law that we talked about before with the individual stock success or distribution of performance, is that power law is kind of happening in the economy. You have AI and everything related to it, like a black hole just sucking everything up into it. And then you got most of the states and other industries in some kind of recession or recessionary period in the US. So there's a very uneven distribution of economic activity that's happening, throughout the economy and the market kind of as a whole. It's creating very different worlds in terms of like successful, unsuccessful outcomes. Like we saw a trend that we used to own, as an example, we were long Chipotle for many years, right? And then recently, in the past year, you started to see a deterioration in the stock trend. So we exited it. And now you're starting to see the news and the fundamentals, like they had earnings yesterday, stocks down 15% for the day. And when you read into the notes, it's like, oh, our young consumers are broke and foot traffic is down and it's going in the wrong direction. So, and which is a symptom and a byproduct of like a consumer segment that just, is broke. And so that's kind of just where we're at in the world. And that these things end up affecting, the market in terms of like which kinds of business models are working and which kind of business models are not working, right? The fact that people who make under $100,000 and can't afford a burrito at Chipotle is not affecting AI, because AI and the CapEx and the customers for AI is like 10 super wealthy, tech companies that are building out data centers and have the balance sheets to do so.
Given the fact that much of the market has been pushed higher or pulled higher by a lot of these AI related themes and companies, as you think about your strategy from a trend perspective, do you not have a large swath of these same kind of uber concentrated companies that an investor might find in, say, the S&P 500?
We have it's a different kind of so we're, as a systematic trend manager who manages risk on each position, we won't cap weight, right? So what's very different about a strategy like ours is that just because a company is a large business or large relative market cap, it's not going to dominate the portfolio. We're kind of equal risk weight in the portfolio. So a stock's relative volatility to one another is what's going to drive its relative to position sizing in the portfolio. But we tend to be more normally distributed, or within some kind of cone of standard deviation of the largest position to the smallest position doesn't look anything like what you would see in a cap weighted index, where 10 stocks are 70% of the index and everything else is just kind of de minimis. In our portfolio, our largest, for a long time, I think it's the second largest sector right now, is industrials. So inside of that industrial trend is where you're going to find AI themes. Now, we don't own mega cap tech or mega cap companies. We screen those out of the universe. Like we're not doing trend following on mega caps, not because it doesn't work, but because it's already over owned. So we eliminate it from the portfolio. Okay. Because if we're trying to deliver investors something different or something unique, why they don't need me doing trend following on NVIDIA when they own NVIDIA in every other portfolio. It just becomes a risk stacking thing. But we do own exposure to that kind of the CapEx that was maybe creating other kinds of successful businesses. Like, people don't think about fixed comfort systems, right? Or Trane Technologies. These are two air conditioning businesses, right? Like, Trane Technologies sounds like a fancy tech company, but in reality, they make air conditioners. Every data center that gets built, right? Then the energy comes in, you have the NVIDIA chips, they produce a lot of heat, got to cool them. So every data center also has to build out these massive amounts of cooling systems. And those cooling systems are basically going and being built by two different companies that are not mega cap tech. They're, mid cap, kind of zone type businesses whose stocks have done very well. So those are the kinds of trends that we end up, see show up in our portfolio that are maybe benefiting from the same economic cycle, but are just not the same names that people see every day in the paper.
Cole, are there market regimes where your strategy performs better, and then market regimes where your strategy underperforms? Walk us through kind of how that works.
Yeah, well, the worst kind of market regime for us is going to be like this year. Like this is a particularly difficult year in 2025 because we came into the year with strong trends. So we're, things are we're loaded. We have plenty of, opportunities for positive trends, and we're risk on. And then, maybe I say we came into just prior to the election. Then after the election or going into the election, the market starts to discount whatever the new administration policies are going to be and the tariff stuff and whatever. And then that ultimately started a corrective phase where we're trimming some positions, or trends are trimming. When the tariff news comes out, like when the market has the tariff tantrum kind of puke to the downside, we go the most risk off that we had been since COVID, and probably got down to a point of like more than 50% treasury bills. And so that's a pretty defensive position, and we would have gotten a lot more defensive if there had been a follow through to the downside. But the market stopped, and then it just does a V bottom reversal and you go back up. So that whipsaw, right, of like market goes down and then it just goes straight back up, that's the Achilles heel of every trend following, kind of whether you're doing it on a stock or you're doing it on copper or cotton. Like any kind of whipsaw reversal is trend following's Achilles heel in terms of a short-term nature of it. So we've had that kind of cycle where, we hedged, we went risk off, and then the markets went right back risk on, and we're going to underperform coming out of that until we can reestablish risk. So that's led where, if you look at us, versus just somebody who stayed fully invested and never did any kind of risk management, they're better off than having, hedged and then come back in.
And I might just make a quick comment just for reference for those listening to Cole's point. That kind of whipsaw environment is definitely the worst environment for trend following. It was from more of like a, systematic long short kind of cross asset trend following space. Second quarter of 2025 was like the third worst quarter going back to the late 90s. So just to put that into perspective and kind of, qualify what Cole had mentioned, I just wanted to share that point.
Yeah. But now relative to multi-asset trend strategies, what we're doing has actually substantially outperformed, right? So relative to other people doing trend, multi-asset trend whipsaw year to date was far worse than the area of just doing individual securities like we do. But that's a difficult, kind of year is this 2025 cycle. The other, or any cycle that looks like that, where it's just like a false positive, kind of thing. The cycle that we do really well in, I would say the most optimal one that we've seen in the last 20 years would be like 2013. So 2013 was a year where you had, I think, the markets in general kind of up every month. Like, I don't think there was even really any real drawdown or volatility throughout the year. So it's just a really strong low vol wave of making new highs. And small and mid cap names, not the large cap stuff that was driving the S&P, was outperforming. And so it was a combination of a positive trend, low volatility, and that segment of the non-mega cap companies were actually outperforming would be the best. That would be like the stars aligning for what would give us the highest absolute and highest relative returns for our strategy. And
to follow up on that, how do you think about when you're talking to allocators in your strategy, how do they think, or how do you recommend allocation? Like, let's take a 60-40 portfolio as kind of a standard. I mean, obviously you have some equity risk here, but you also have some downside protection. I mean, how do you think about what percentage is the right percentage for a strategy like this?
It's very dependent on what the advisors or the investors most concerned, kind of with. If somebody was saying, I'm really concerned about, I just want to have the most uncorrelated strategy possible, I don't care about returns, I don't care about, then my answer would be maybe Longboard is not the right fit. I could find you other assets that statistically had much lower correlation, and that would be a better fit for your portfolio than not. So the answer is it depends on the investor's objective and what they're trying to do. I would say, though, that for our clients or people who are kind of using funds like ours, like trend following strategies, they tend to have some kind of diversifying sleeve, whether they call it an alternative sleeve or something, some risk management sleeve. They're putting probably 20%, right, of the overall pie is going into that sleeve, because something less than that is probably not really going to move the needle. If you put a 5% sleeve into your alts thing, it's like, I don't even know you're going to notice the difference. So, and then within inside of that sleeve, they're using a couple, different strategies. Like, I would never say that Longboard is the appropriate, like, hey, use a 20% alt sleeve and just use our fund, or use this one strategy. You really need to have strategies that standalone are very good investments, but that are uncorrelated to each other and don't take the same risks. Like, I always give advice that you should use at least 3 different strategies, and those 3 strategies should truly be different. Now, those 3 strategies could be trend following strategies. I'm not saying, but they can't be trend following strategies that do the same thing, right? So if you put Longboard, we're unique in what it is that we do. We have very low correlation to other trend strategies. So if you pair us with a multi-asset, long short, commodity trend type thing, they're going to complement, one another, and you get those 2 strategies. If you have somebody else who's trend, but they maybe only do it on, I don't know, just commodities only, maybe, then that's going to have a different kind of correlation thing. But using 3 different strategies with 3 different true risk drivers and true unique uncorrelatedness between one another is my kind of minimum golden rule when it comes to constructing, these things. You don't want to be overly dependent upon 1 or 2 things to be your source of diversity.
And I know it's a bit of a moving target because you have that cash lever that you can pull, but across a full cycle, just for listeners to kind of place this within other diversifiers, what is the historical correlation profile been for the strategy relative to, say, like the S&P 500?
Since inception, so going, back over, 10, 11 years, about 0.5.
Okay.
So yeah, like I'm saying, like we're providing meaningful diversification, and something that's unique and different, but it's not zero, right? We're not trying to be, zero, because in our world, if you finding something like nirvana for any kind of alt strategy would be like, find me something that has genuinely zero correlation, but also very high absolute returns and very high risk adjusted.
I get that question all the time. I was like, I'll let you know.
And I'm saying, if you find that vehicle, please call me, because I also have my own money to put to work. I think that you're really just trying to get closest to that nirvana kind of thing that you can through different products and solutions that are out there. You can get average correlations to be low in systematic multi-asset trend, but you also get 9 out of 10 years where you're frustrated with the investment and you have low nominal rates of return. The variance is very high, and it has other weaknesses to it. So it's about blending things together, and everything has a weakness and a strength, and finding things where this strategy's weakness and this other strategy's weaknesses are not overlapping with one another. They're not going to be weak at the same time. Is my approach to portfolio construction kind of in that.
Yeah, I think too, and again, knowing where I sit in the industry and being in that more kind of cross-asset, systematic, long-short, unconstrained trend, a common obstacle that we face is, from an educational perspective, this is a new frontier for a lot of advisors, and then that educational hurdle then becomes the advisor might understand it, but it's like, there's no way I can have this in a portfolio and explain to my retail client what's going on here. And so the fact that you've applied something that offers this low correlation for a diversification standpoint, but also allows for upside participation in a rallying equity market, and it is a way that's digestible so both advisors and retail clients can wrap their head around it, I think it becomes a really logical, easy way for advisors to introduce alternatives, trend following into a portfolio. Because at the end of the day, if we're talking about individual stocks, which most people love to talk about and they understand them, and it's simply looking at, rising price trend and why that stock might continue. And especially with the backdrop of where we are today and technicals leading a lot of markets higher rather than fundamentals, I just think it becomes really digestible. And that's why I was excited to have you on today, Cole. Is like the first time that you kind of presented this to me, I said, oh, this is a much broader use case, I think, than the systematic long short trend is, because that has so many barriers or hurdles from an educational perspective.
Yes, I mean, that's why we designed the product, in the way that we have, or at least, whether it was consciously that we started it and said that, I'm not going to say we were trying to solve that problem, because I started the product long before we knew that was a problem. But then we realized that, well, doing systematic trend on individual stocks is actually just a better way of doing systematic trend. If your definition of better is it has a better investor experience, therefore people will stick with it longer. And if your definition of better, it has an infinitely higher compounded annual growth rate, or your definition of better is that it has a superior after-tax return because stocks versus futures is just better. So there's a lot of features on here. The one area that it just doesn't win is the criteria of, is it the absolute lowest correlation? Like, no, the multi-asset long short will have a lower average correlation, but then it's going to like lose on every other criteria. So it's important to understand, what is your criteria? What's most important to you? For most people, I've actually never found somebody where the only criteria that matters was the absolute level of average correlation and none of that other stuff.
They might tell you, and then all of a sudden when you start posting returns that correlate to that low correlation, they're like, wait a minute, I thought we were going to get equity like returns with zero correlation.
Well, the only person who's ever told me that that's all that matters was somebody who was running a portfolio manager that was running a systematic multi-asset trend following fund. No investor in those products has ever told me that that's the only thing that matters. And their behavior with how they voted with their money, will tell you that. You can just see that, there's a lot of investor flow behavior into the systematic trend world, both in the institutional and the retail level, that tells you that there is a lot of dissatisfaction with the product formulation of funds that just do that multi-asset classic trend following kind of thing. They're kind of like unfinished products, and they're component pieces. And what you've seen, there are different people in the world. Like there's some other funds out there like Catalyst or the Standpoint, where Abby has one also, where they kind of are hybrid structures of putting equity beta combined with multi-asset trend type things and into one fund. Well, what that does is it changes the return path profile, because now it's like 50% S&P, 50% low correlated multi-asset trend. And it's a fusion of the two that balance each other out. The multi-asset trend offsets the weaknesses maybe of just a pure S&P 500 only, and vice versa. S&P 500 drags up the returns of the low return multi-asset, kind of thing. And it's much more emotionally appealing to end investors. And you can see that in the fund flows. Those funds raise and retain more assets than their average fund that just does pure multi-asset trend following type things. So in our product, the difference is like, I don't owning, and if you're going to be in an alt sleeve and you're going to be truly like risk management and you can actually really, really survive, I don't like being so dependent on the correlation of the multi-asset trend strategy to offset the risk of just constantly being in an equity beta position. If you have a 50% loss in the S&P or 80, there's a depression, like whatever, these are rare, events, but they can happen, right? And our job as an alternative strategy is to those are unacceptable risks for us to position yourself to be able to lose that kind of money. So we're a pure alpha strategy where everything that we do is an active trend following. We don't have any passive beta exposure. I don't have any situation where half our portfolio is just going to go down 50% or 90% in a depression. If there's a depression, I'm going to be sitting in treasury bills during that whole period of time. And I'm not going to be making a lot of money, but I'm not going to be losing money. And then at some point there will be a new cycle that emerges that will be able to reinvest. And I'm a lot more comfortable with that, kind of approach, which both solves the multi-asset trend performance problem, but without adding a new problem, which is I solve the performance problem by just cramming a bunch of equity beta into my portfolio and hoping that one offsets, kind of the, the other. So it's just a very different way of going about solving the performance problem.
Yeah. And I might also just say I've had the opportunity to sit down with Cole and his team, and they ran me through some of their slides and visuals. So I would highly suggest anybody listening that has interest in their approach, philosophy, and strategy to reach out, connect with them, because the dynamism of the strategy moving, in and out of cash as risk off markets appear, the process that they take. Again, I found it really compelling. And this is me for my day job sitting in the role of being essentially a direct competitor, which is why I was so excited to have Cole come on. So maybe we'll wrap up. A question that we like to ask our guests is there anybody in the industry or personally who's made a large impression on you in your career? Because at the end of the day, our podcast is called Building Better Portfolios with the tagline and Better Lives. So we like to kind of weave in some of that personal shout outs, if you have any that you'd like to give.
Well, I mean, a personal shout out to me would be the folks at Standpoint Asset Management. I used to work with all of them. I think every employee at Standpoint was a former Longboard employee, and my longtime business partner and director of research at Longboard was Eric Crittenden, who's the founder and portfolio manager, there. I would say I met Eric, 25 years ago or something, and we had 15-year journey of research and development and intellectual curiosity that, was fundamental to kind of our careers together and what we did together, what we've done independent from one another. So, there's no doubt that kind of him and our collaboration and working from a research standpoint was the most influential when it comes to the trend, kind of part of it. And then, the rest of the folks at Standpoint, as well, like we all built a business together from nothing at Longboard and went through that, that journey. And I learned a lot, from them and that experience that, kind of carries with me today. So can't, shout out to those folks and the impact that they had on my life and vice versa, the successes that we've had in life.
I love that. Josh, any other questions from you before we wrap?
No, I think this is fantastic. Cole, thank you for joining us.
Yeah, thanks for
really
having me.
Appreciate it. And like I said, definitely reach out to Cole and his team. They have a lot more that they can share on strategy specifics. But that concludes episode 9. So thank you, Cole, for hanging out with us today.
The views and opinions expressed on this podcast are those of the host and do not reflect the views, opinions, or policies of any current or former employer, affiliated firm, or client. The content is provided for informational and entertainment purposes only and should not be considered investment, legal, or tax advice. Nothing discussed constitutes a recommendation to buy or sell any securities or investment products. Listeners should conduct their own research or consult with a qualified professional before making any financial decisions. The hosts are speaking solely in their personal capacities, and the podcast is not affiliated with, sponsored by, or endorsed by any firm or organization with which they may be associated.